Hello students, welcome to the study of social science. This is the third video lecture of Economics Chapter 3 Money and Credit for Class 10th. In this video, our topics are loan activities of banks, two different credit situations, terms of credit. You know that a person who deposits money in the bank is called a depositor. And when a bank gives loan to the people, then the bank becomes a lender and the person who takes a loan from the bank is called a borrower. Thus, a person who deposits money in the bank is called the depositor and the person who takes a loan from the bank is called a borrower. We know that people deposit their money in the bank for two reasons, for safety and for the interest they get on their deposits. But the question is, what do the banks do with the deposit which they have accepted from the public? Or how do the banks use the money deposited by people? The banks keep only a small proportion of money deposited by people, and a large part of deposits bank used to give loans. Banks keep only 15% of deposits and 85% of deposits bank used to give loans to the people. Banks provide loans to people for their economic activities like for starting a new business, purchasing a house or cultivating crops. Now the question is, why do banks give loans to the people? Or what is the main source of income for banks? The banks give loans to the people for making a profit. Banks charge a high interest rate on loans, a higher interest rate than the interest rate the banks give to the people on their deposits. For example, if a person deposits 1 lakh rupees in a bank, the bank will give only 2 to 3% per year interest on his deposit. But if he takes a loan of 1 lakh rupees from the bank will charge nearly 10 to 15% interest rate per year on the loan. That means if you are taking a loan of 1 lakh rupees from the bank will charge 10,000 rupees per year interest on your loan. You would have to pay 10,000 per year to the bank as the interest of 1 lakh rupees. But when you deposit 1 lakh rupees in the bank will pay only 3,000 rupees as interest on your amount. This difference between interest rates is the main source of income of bank. Let's observe these two situations and find out how this loan or credit works. The first example is of Salim. Salim is a shoemaker who got an order of manufacturing 3,000 pairs of shoes. To complete the order, he took two loans, first from the leather suppliers and second from a trader. At the end of the month, Salim was able to deliver the order. He made a good profit and he also repaid the money that he had borrowed from the leather supplier and the traders. Thus, in this situation, loan plays a vital and positive role. Another example is of Sapna. Sapna is a small farmer. She took a loan from the money lender for cultivation of groundnuts. But due to crop failure, she was unable to repay the loan. Thus, next year again she took a fresh loan for cultivation and to repay the old loan. But unfortunately, this year too she did not earn enough to cover the old loan. And she was caught in a debt trap. She had to sell a part of her land for paying off the debt. Thus, this is a painful situation where a loan pushed the borrower into a debt trap. To repay the loan, Sapna had to sell a part of her land. Thus, whether credit or loan would be useful or not depends on the situation of the borrower. There should be some support in case of loss. Our next topic is terms of credit. Terms of credit or terms of loan include the interest rate, collateral, documentation requirement, and the mode of repayment. The interest rate is an amount charged by the lender to the borrower. And collateral. Collateral is an asset. It could be a property such as land, building, vehicles, livestock that a lender accepts as a security for giving a loan. That means at the time of taking a loan, borrower gives the collateral to the bank as a security. If the borrower defaults, fails to pay the loan, then the bank can seize the collateral. The bank can take over the collateral. So the collateral is the asset which has been given to the bank by a borrower as a security for the loan. Documentation requirement. Many documents are required for a loan, such as loan application form, passport size photograph, identity proof, residence proof, and bank account statement. So these documents are required for a loan. And the mode of repayment. There are many ways in which one can repay the loan, like monthly deductions from salary or direct monthly payments in cash. Thus, the interest rate, collateral, the documentation requirement, and the mode of repayment together are called the terms of credit. In short, the banks keep only a small proportion of money deposited by people, and a large part of deposits bank use to extend loans to people. Banks charge high interest rate on loans. The difference between what is charged from the borrowers and what is paid to the depositors is the main source of income of the bank. And whether credit or loan would be useful or not depends on the situation of the borrower. There should be some support in case of loss. The interest rate, collateral, the documentation requirement, and the mode of repayment together are called the terms of credit. So that's it about today's video. In the next video lecture, we will discuss next topic of this chapter. If you like the video, please do like, share with your friends. Thank you for watching. Have a nice day.